Have you ever wondered how the Federal Reserve's next move is going to impact your mortgage rate? Because whether you are a homeowner or looking to purchase a home very soon and waiting to see what they do before you make that move, the Fed's decision can feel like the thing that is going to make or break your timing. But here's the truth: mortgage rates usually move before the Fed does, and understanding why that happens can help you make smarter decisions rather than waiting on the sidelines. Let's dive into it. So, what exactly is the Fed funds rate? It's a short term interest rate that banks charge to each other to lend money overnight. The Federal Reserve sets a target range for that rate to help control inflation, encourage borrowing, or cool down spending when the economy and inflation are running hot. When the Fed raises the rate, borrowing costs go up for things like credit cards, business loans, auto loans, and that slows down the economic activity because it is likely a deterrent for people to get into more debt. But when the Fed lowers the rate, then borrowing money becomes cheaper, and then that helps stimulate growth. Now, mortgage rates don't move directly with the Fed funds rate, but it still matters because it shapes how the investors see the economy and inflation. That in turn influences the long term rates, and those are the ones that impact mortgage rates. One of the tools that I like to use and is available to the public for free is called the CME FedWatch tool. It shows what investors are predicting that the Fed is going to do at the upcoming meetings and whether that's going to be raising, cutting, or keeping rates steady. Now, if the market expects a 90% chance of a rate cut or a hold, those expectations are already built in today's mortgage rates. So if the Fed follows through as expected, then mortgage rates may not move at all or could potentially improve slightly if there's enough economic data to support it. That would be things like inflation reports showing that inflation is decreasing, or the jobs reports or unemployment reports showing that unemployment is rising. Unemployment rising, while it's not great for households, would in turn likely make households not spend money, which would then result in the Fed wanting to stimulate households to spend money and makes borrowing cheaper. Now, if the Fed surprises the market, that's when rates can react sharply. So, when you see a sudden change in mortgage rates, it's likely not often about what the Fed did, but what the market was expecting, and then if the Fed's move matched those expectations. To really understand what moves mortgage rates day to day, you have to look at bond market activity because that's where the long-term interest rates are set. What is the bond market? That is where investors buy and sell debt like a government bond or mortgage-backed securities. When investors sell the bonds to buy stocks, rates rise. On the flip side, when investors buy bonds and sell stocks, then rates fall. So mortgage rates often move in the same direction as bond yields. When investors feel confident about the economy, they shift into stocks and away from the bonds. This pushes bond prices down, which in turn makes mortgage rates increase. But when investors get cautious, maybe about inflation or jobs or even global uncertainty, they move money back into bonds, which pushes yields and mortgage rates lower. Now, if you bought your home in 2023 using a 2-1 buydown, that was during a period when the average 30-year fixed rate was staying above 7% for about 4 months. And according to Freddie Mac's primary mortgage market survey, they ended up peaking at 7.79% for the week of October 27th, 2023. So if your temporary rate is about to adjust back to those levels, now would be a great time to explore refinancing strategies while these rates remain below those 2023 highs. So what does this all mean for you? If the Fed and the markets are aligned, mortgage rates will likely move gradually, not dramatically. But when inflation or job data comes in unexpectedly, that's when we see the bigger shifts. The key takeaway is this: you don't need to wait for the next Fed meeting to take action. You can start preparing now by reviewing your loan, checking your credit, planning your next move before rates or market conditions change again. You don't have to be an economist to make smart financial choices. That's my job. I've spent over 20 years in residential lending studying how markets, guidelines, and timing all come together to create opportunities for homeowners. So, whether it's optimizing when to refinance, comparing long term fixed rates, or finding creative solutions that fit your financial goals, my mission is to make sure that your strategy fits your story, not the other way around. My name is Amber Jones. I'm a certified mortgage advisor, and I'm here to help inform you, empower you, and help you solve that financial obstacle that you're currently facing wherever you're at on your homeownership journey. I would love to have a 15-minute phone conversation with you to help address your concerns, answer all your questions, and then help you plan those next steps. All of my contact information is below, where you can book a 15-minute phone call with me at a time and day that works best for you. I hope you found this information helpful. And if you did, I would love it if you liked the video, subscribed, but most importantly, shared it with a friend. I hope you have an amazing rest of your day, and I'll see you again next time. Bye bye.